Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Michael Normyle, U.S. economist at Nasdaq, to discuss why the Fed paused interest rate hikes in June, as it has some time now to work through data points. It is great to see you, Mike. Let's talk about the market reaction going into the announcement this afternoon.
Sure. So over the last week, we've seen the major equity indices rise about 1 to 3% prior to what the Fed did at 2 p.m. this afternoon. And we'd also seen 10-year Treasury rates kind of hovering around 3.8% over the last week. Some ups and downs in between, but more or less in that range. But of course, with the announcement today, we've seen some of the gains in stocks pull back a bit and saw Treasury yields increase 10 basis points or so.
Right. I mean, the expectation was the Fed was going to pause here. It's the fact that the dot plot shifted around a bit that kind of has the market rethinking, oh, it's not just one hike, it could potentially be two hikes going into the end of 2023. Let's talk about CPI here, because of course that's a key piece of data that the Fed uses to develop its strategy. What about the contributions to annual CPI?
Right. So with the CPI data earlier this week, we had headline fall to 4% year over year from 4.9%, and core fell from 5.5% year over year to 5.3%. So we were making some progress there. And specifically with headline, it's really been a lot of energy, where we've seen negative contributions from energy for the last 3 months. But we're still not making a ton of progress in some other areas, like food has been a pretty steady contributor. And then, of course, the kind of core services that the Fed's really been focused on with housing and more wage-driven stuff. Those have been holding up, but there are some positive developments that we're seeing there.
And let's look at a couple of those. We have used vehicles, used shelter. What are you seeing there?
Sure. So with used vehicles, that's it tends to be led by auction prices for used cars. And so those had increased earlier this year. Maybe we saw car rental agencies having to restock their fleets a bit, so that pushed up demand in that area and drove some increases in those auction prices. But the last few months, those have come down, so that is a good sign that used car inflation, which has been 4% month on month for the last couple months, should start easing off a bit there. And then moving on to food, we have fertilizer, which is, of course, an important input to food production. And so last year we saw a big spike in fertilizer prices, and that had to do with the war in Ukraine, because natural gas is an element in the production of fertilizer. So that's been rolling over now. It spiked above 100% last year in year-over-year terms. Now it's down to negative 45%. So a really sharp drop there. So that should help drive food prices lower as well, slow the food inflation. And then, of course, you mentioned shelter already, and that's something we've been watching for a while, where the market-based measures have been rolling over since early last year in response to the Fed increasing rates, which hurt housing demand. And so we've seen rental prices and home prices rolling over, but since CPI is a sample of all homes, not just newly sold homes or newly rented homes, it takes time for them to filter into that sample and become a big enough chunk of it that's bringing down shelter inflation. And we're just starting to see that. But we know from the kind of leading indicators, the market-based measures, that more of that should be coming through. And of course, lastly, we get a little help from base effects. So essentially, a year ago is when we had peak rates. That's where we had 9.1% inflation in June of last year. And so just arithmetically, when we're comparing the next month of data that we get for CPI, which will be June of this year, it's going to be compared to the highest inflation period that we had last year. So just by virtue of comparing it to a really high number last year, it's going to be hard for June 2023 to be another high number.
Well, let's hope so. Let's take a look at monthly CPI data.
I'm sorry, monthly CPI data? That's the base effects that I was speaking about earlier. So that's something that we need to watch over the next few months, because it is still going to be that same situation where we're looking at a strong summer period of inflation, where of course it peaked last June, but it was still high for the several months following that.
So let's put all this together. How is this going to impact Fed policy? I mean, I'm sure I think the pause makes sense. Let's kind of see what's happening. Are these things working? Is it filtering through, and it isn't just like a one-time blip on the radar, not something that's a new trend?
Exactly. So that was the whole point of the pause, right? They want to buy themselves a little time to assess how the hikes to date, which is 500 basis points, are flowing through into the economy, and they know that monetary policy works with lags. So they had 10 straight meetings of hiking rates. So this is the first time in 11 meetings that they don't do anything. But with their projections, they did signal that they're looking at 2 more hikes, but that's all data dependent. So we have to see what happens with inflation going forward. And as we've discussed, there are some positive developments in the pipeline, which should be helpful for the Fed. And maybe that will allow them to trim it back to 1 more hike, which is what the market had been expecting.
All right. Appreciate the insight as always, Michael. Thanks for joining us on Trade Talks. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.